So welcome to Market Analysis Live for December 13th of 2015. This is George from TRADEPRO Academy. We got an exciting, super exciting webinar for you this evening because this lady is about to live in your dreams until Wednesday at 2 p.m. And I feel sorry for all of us that has to happen, but it's Fed week. We're here. We're finally up to that day, the all-important day that people have been blabbing about for 9 years. 9 freaking years. Interest rates have stayed low. Actually, 9 years since the last interest rate increase, but the recession since 2009. So it's about 6 years since the market's absolutely tanked. And for those of you that know about the 7-year cycle, well, that's an interesting piece altogether that we could look at. But this lady is going to rule our lives until Wednesday at 2:30 p.m. A lot of things are going to happen this week. For this webinar, and this webinar only, I strongly encourage you, because I made it free last minute. I didn't know whether or not I was going to invite other people. But I think this is information that we should share with the entire world, isn't it? And if you guys want to invite people, then I urge you to do so by going at the bottom, or where is it? The bottom left here. If you have friends you want to invite, think of it as sharing with them. Click the button, invite them, let them come on in, and I won't kick out any newer strange faces in our member zone here. If they come in, I'll let them enjoy the webinar. So if you think they could benefit from this information, invite your friends, invite your family, invite your pet if they have a Facebook profile, whatever you want to do, bring them out here because this is very important information. So a lot of things are going to happen this week when the Federal Reserve does their hike, if they do it. So we got to talk about a plethora of information here, and I want to show you one thing. If you go FOMC Fed futures, I'm going to show you what the likelihood of an interest rate hike is baked in at the moment. It's very high. We're almost at the 88% level. Last I checked, that was of course before the carnage that took place on Friday. This is down a little bit, so it's down to 80% chance of a 50 basis point hike. Okay. Current probability is almost 80%, down about 5% or so because the market dropped a lot. I'm going to tell you something. The Federal Reserve does not care that the market dropped the last 2 days. They've already prepared and made up their mind that they're going to raise interest rates, and I think they're going to do it. I think tomorrow, for the first time in 9 years, we are finally going to see an increase in the key lending rate, which can have massive implications for equity markets overall. So I'm going to take you through these slides. Remember, the information contained in tonight's presentation is for educational purposes and does not constitute investment advice. The risk of trading in securities markets can be substantial. You should carefully consider if engaging in such activity is suitable for you and your own financial situation. TRADEPRO Academy and or its affiliates or myself or anything else that is TRADEPRO Academy related is not responsible for any liabilities arising as a result of your market involvement or individual trade activities. Okay. All right, I think that's the fastest I could actually read. Now that you've agreed to that, tonight's agenda is the Forex Factory Calendar, MMFI, and the Fed hike preparation and how we're going to trade it. We're going to have a few blockbuster trading opportunities here. And I'm going to say this, if you're not very seasoned with options trading, if you're a panicky personality, if you freak out at the slightest inclination or slightest thing, then you probably shouldn't be trading this. This is going to be a very volatile event. And if you have any heart conditions, you probably shouldn't be trading it either because you might have a heart attack. If you have to drill 42 holes to put up a shelf with only 16 holes, then you probably shouldn't be trading. Inside joke. But here's some of the information that we had last week from the Forex Factory Calendar. We had some pretty good numbers actually come out in the U.S. for retail sales. Unemployment claims were not fantastic, but they were slightly higher, about 20,000 or so. In 266, so about 8% higher than expected. At this point, unemployment won't really affect the Fed hike. The Fed's already made up their mind. People read into this a little bit too deeply. That caused some panic, caused a bit of a sell-off, and you guys saw what happened in the markets. I think it was a little bit overdone, but I'm biased. So there you have it. What are we looking at next week? We have a little bit more in terms of economic events. The biggest one is Wednesday, December the 16th at 2 p.m. FOMC projections. The statement is going to be released, and that statement is literally going to say, boom, here's what we're hiking it to, 0.5%. All right, which is a quarter of a percentage hike. So it's not a big deal. But it's not the number that we're trading here. It is the implication that they are starting to raise interest rates. Why is this absolutely nuts? Well, because everybody in the world is actually reducing interest rates. In fact, Europe has negative rates, okay? And they're also, in addition to that, purchasing bonds, which creates stimulus and floods the economy with cash. So the United States is about to take an unprecedented and historic rate hike after 9 years of their last rate hike and increase the rates against the momentum of the entire world. That's why it's kind of a big deal. Why do they feel like they have to do it? Well, because unfortunately they said they were going to do it in 2015. They spent a lot of 2015, especially towards the end of the 2015, they spent a lot of that time saying we're going to raise interest rates, we're going to raise interest rates. This is their last chance. If they do not do it this Wednesday, they have no chance. They have no credibility. Okay, here's the thing. Losing credibility and having no credibility assumes that you have credibility to lose. And I'm not sure that they have too much of it because they kind of played around with everybody in the last couple of months, haven't they? September, they were supposed to do it and they didn't. So I don't freaking know if they're going to raise interest rates. Nobody knows. All right? In fact, I bet you Janet Yellen is turning in her bed right now. Wow, it's 8:10 p.m. Yeah, she's sleeping. She's in Germany. Or not Germany, what am I talking about? She's in the U.S. She's sleeping probably early. She's probably turning in her bed or on her couch or whatever she's doing. She's freaking out, and she may not even know. All right? She may not be certain if it's the right move. At this point, though, their projection, their statement is already prepared. All right, guys? It's already done. They made up their mind. Whether or not they're going to hike it, you can see the market expects a hike. Whether they do it or not, that remains to be seen. I am 80% sure that they will probably raise interest rates because that's what the Fed futures are telling us. All right, I'm not smart enough to know. I don't know Janet. You know, I wouldn't invite her over to any of my dinner parties. So therefore, I don't know. I can't give you any kind of precision. I can tell you market's expecting 80% rate hike. I mean, therefore, 80% of that is baked into what's already happened in the markets. So at this point, saying no, we will not raise interest rates would ultimately be a better thing for equity markets. However, it's going against expectations, and that might ironically tumble markets. Because if they actually go in and say, we are not going to raise interest rates, what they are basically saying is we do not believe the economic recovery, I'm going to put recovery here in little quotations because who knows how much of a recovery has been going on in the last 7 years. But anywho, that would mean that the economic recovery hasn't been really taking shape. They don't believe that there's any strength and recovery going on. Therefore, they might say, we're not raising rates because the economy sucks. And if the economy sucks, then the market might actually take that negative, which is the right thing to do. All right, despite not raising interest rates, which is typically a market positive, the market might actually interpret this as a bad event because the economy is going to down the tube, therefore it sells off. So there's a few likelihoods and scenarios here. I'm going to break them down for you, and then we're going to look at the market and do all the trades that we would set up in case each one of them take place. The first scenario is that the rate hike happens. Okay, 80% chance, boom, it happens, and it's only 25 basis points. That is the least volatile of all the scenarios because we think option number one is already priced in. Option number two is no hike, and no hike will be a crazy volatile atmosphere that might spike up, might spike down, might do both. It's going to be madness if number two happens. The market will struggle to adjust that into the current price, and it doesn't know how. And number three is that the hike is actually 50 basis points or above or more aggressive. Now, remember, there's two things that's important in the grand scheme of things. Number one is the actual rate itself. Now, that's important because it's a known. But two, and I would argue more important than the actual rate hike itself, is future guidance. Okay, and I'll tell you what I mean by that. If they say in 2016 we expect the rate to be, right now it's 0.25. So they'll say, you know what, we're going to do a rate hike right now, 25 points to 0.5%. It's not a big deal. By the end of 2016 we expect the rate to be 3%. That's huge. That's massive. That means that the Fed meets 4 times a year. That means in each one of their next meetings they're probably going to have to increase the rate, and they're committing to that. And now if they actually hike it, they've saved some of their credibility, so the market might believe them. And what would happen if they say, you know what, then 2016 is going to be 5%. Almost impossible to say this, but if they say this, the economy will absolutely tank. I guarantee you, because it cannot sustain a 5%. Now, the more likely of all scenarios, and what I think is going to take place next week, will be the following scenario. Hike, number one, hike of 25 basis points to the rate, and future outlook or guidance or projection of interest rate will be somewhere between, I don't know, 0.5 to 0.75 in 2016. So very, 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 very little future indication on what they're going to do. They're going to basically say, we're going to do it really slow, really cautious, and yeah, it's basically like, we just sent a newsletter out. You guys are going to find it funny, comparing the market to a drug addict, and I wrote a little note of what Janet Yellen would send that drug addict, and it's basically saying, we're going to cut your dosage a little bit, just barely enough for you to notice, but should you notice, don't worry, we're going to supply you free drugs for a long time. All right, so they're really walking on eggshells. So that's what can happen. Those are really the three scenarios. That's what's important to you. There is the Fed madness in a short little spiel of 10 minutes or less. We're going to look at the trades that we would set up under each scenario, but I'm going to tell you, this week is not a week for you to go in not knowing, I don't know what's going to happen, and not being certain. This week is a week for decision. You've got to decide you believe in one scenario and set up your trade and be confident. If you can't risk money, if you got $5,000 and that's all the money you have to trade with, I wouldn't be in this market at all. All right? If you want to chunk off, let's say $2,000 and say, you know what, I'm willing to take a trade. I'm going to bet that something's going to happen, and if I lose it, I'm going to realize that it was an event that I had no control over, so maybe I deserve to lose. If that's your attitude, then boy, do I have some trades that can make you 5 times your money this week. Okay? You could also lose it all, so just be careful. This is an uncertain event. If you like certainty or if you're new to trading, stay away. Watch it from the sidelines. It's better for you. It's a learning experience if you watch from the sidelines. If you're losing money, you're now paying tuition. It's no longer just a free learning experience. All right? Other than that, nothing else important this entire week. Nothing. This means absolutely nothing. Thursday and Friday, market's going to be just digesting what happened Wednesday. Okay? So that's a big day. It's a massive day. It's worth taking off if you're actually serious about trading it and working full time. I would take that day off easily. MMFI index. Stocks are now average priced in this scale. We said in the last couple of weeks they had to go down. Fortunately, we were right, or unfortunately for some, right back down to where they historically are. So the 40 to 50 marker is on average where 50-day stock should be. So they were overbought here. They sold off very sharply. Now they're in neutral territory. Will they bounce back or continue their downward trend to about 10%? We don't know. We're going to keep an eye out on that. But for all intents and purposes, it is not overbought or oversold. They're just neutral at the moment. We're into neutral territory, neutral section of the markets. All right, in terms of rate hikes, I wanted to bring you back to a few times at which the Federal Reserve has hiked interest rates. And I want to, Arun, welcome to the webinar. It's free as a one-off. We usually do this every Sunday at 8 p.m. I hope you really enjoy it. And if you really enjoy it, you consider trying it out 4 more times in the next month. Because if you sign up, you get it free for the next month. Anywho, quick little sales pitch. Welcome. So every time that the Feds hike these rates, I wanted to assure you that collapse hasn't ensued. And this time may really be different. But look at this statement. Time frames highlighted in green are periods when the Federal Reserve is actually increasing its target rate, its lending rate. All right. Generally speaking, those periods have come with upward movement in the S&P 500. Upward movement in the S&P 500. In fact, studies done in the past indicate that the S&P generally earns between 8 and 10% annually when interest rates are moving higher. Why? Well, the Federal Reserve usually raises interest rates higher when they have confidence in the economy. Now, I know that the economy absolutely blows at the moment. All right, it sucks. It's not really good from the perspective of unemployment. Okay, there's a lot of people that aren't working, that can't find stable jobs that they like, which is important. They might be working service industry jobs in retail, which is a large chunk of employment, but that's not a good job. That's not a job that anybody dreams of having. Nobody wakes up and says, I want it to be a salesperson at Best Buy. All right, nobody does that. It just happens to pay the bills. And those unemployment numbers are kind of bad. That's what they call slack in the labor market. All right, commodities are now getting crushed. Oil prices are lower. And if you look at jobs from 2009 onwards, a lot of the growth and addition of jobs were in the oil sector. That's no longer the case. People are not getting fired left, right, and center because oil companies aren't making money. Okay, in fact, nobody is producing oil at that price. Nobody at all. Nobody. Not Saudi Arabia. No one at all. Not Kuwait. Not Venezuela. Not the United States. Zero people. The total number of people making money off oil sales at the moment is zero. So, Fed rate hikes in green. Look, it happened here 85 to 89. Fed hiked from 5 to 10%, which is the highest the rate has ever been for the last couple decades. Market positive. All right, here was another Fed hike towards the mid-90s. Market positive. 2000 to 2004, market positive. We had a bit of a retracement. We bottomed out. We started coming up, and the Fed started hiking rates once again. Market was positive. The difference now is they probably should have started hiking right here. All right, that's a big difference. Look at this. Each one of these crashes were accompanied by interest rate hikes pretty shortly thereafter. And then we hit new highs. When they pulled the interest rate hikes, markets dropped. So what you're seeing here is uncharted territory because what I believe is Bernanke started this whole mess. All right, Bernanke baked this pie that had a really nice crust to the outside of it. Smelled really great. All right, and looked like it had strawberries on top, but in the inside it was full of horse dung because that's the pie that he handed to Janet. And Janet said, Janet Yellen said, wow, what a nice job. But she got stuck with this. She got stuck with record market growth in a record low interest rate environment. All right? If I'm giving you money and I ain't charging you anything for it, you're going to obviously take it from me, right? If I'm charging you a ridiculously low rate, you're going to take the money from me. You're going to take the candy. You're going to grab the bait. That's why she's stuck in a very, very tough spot where markets are rounding out. She should have started hiking here in 2011. All right? Ben Bernanke should have started hiking in 2011 before he passed it off in 2013, actually 2014 to Janet Yellen. Or it might have been 13. That's the problem. That's why the market's freaking out right now because we waited a little bit too long. But what I wanted to show you with this chart is that it's not all chaos and disaster. Now, the potential impact of a rate hike on the S&P 500 market, it is positive for all sectors, including the overall equity market, based on Street Authority study done, except one, and that is utilities. Utility companies will not fare as well. S&P 500 expected to do well in a rate hike. Energy expected to rebound. I'm going to tell you something. $36 or $37 a barrel of oil might actually be the bottom. There might be the point at which it stays down here for a little bit, but I don't know if we're going to get another wave down. I don't know. And if we do, it certainly won't go much lower than $30. And I'm not going to catch the falling knife. When prices are dropping, think of it as a massive knife coming down from the 11th floor of a balcony. You're standing on the ground floor. You're not going to throw your hands up here with your friends and try to catch that knife. You're not going to do that because it's going to hurt. You're going to let it fall, bounce, and then pick it up. That's what I'm waiting for. Fall, bounce, stabilize. I see volume start increasing and prices breaking a high. I'm going to get in and ride a bit of a rebound. So we're energy positive going into 2016. That's the key and the core concept here of the year. In 2 weeks' time, by the way, we're going to do our annual market prediction webinar. It's free to everyone. Mark it on your calendar. It will be January the 3rd. Actually, sorry, it's not 2 weeks. I believe it's 3 weeks. Yeah, it's 3 weeks. January 3rd, it's going to be our annual prediction calendar, and we are, so far for the 3 years we've done it, 100% accurate on what's happened. So, yeah, we've done pretty well. It's a pretty tough track record to defend. So potential impact is expected to be positive. Don't freak out from these interest rates hikes that are coming this week. It might actually be a good thing. It's time in a healthy environment to start raising them. I wanted to show you one other thing that I'm going to flip here on the screen. What happened to markets the last 15 times the Fed tightened? So I pulled off a little study. December 1965 to 1966, there was a rate hike environment. We went from about 3.25% to 6%, so 3% increase in the span of a year. Here's what happened, all right? That was not good. The S&P 500 dropped a lot. This is 1965. It's a totally different world. Okay, so that was a negative cycle as soon as interest rate hikes began. Look at this. August 1967 to September 1969. In 2 years, it was a 5% rate hike. All right? And then they had to drop rates. So I'm assuming the market, guess what? It initially took it with volatility, then recovered, and then it dropped right afterwards. You could see a positive correlation of interest rates. If they go up, market tends to go up. If they go down, market will drop. All right? But be careful with the cause and effect here. Just because something's happening, it doesn't mean that one thing is causing it. Be very, very careful when making that assumption. April 1971 to September 1971, 1 year drop followed by a hike. What happened to the market? Negative. All right, so far we're 1-1. 1972 to October 1973, interest rate hike environment. Market went up initially, then dropped and stabilized. Okay, let's look at 1974. Rates skyrocketed, then dropped, and the market did what? It got cut off. Let's see if we can actually follow this to the website, because this, I'm going to pin this to our what is it called? I'm going to pin this to our Evernote workbook. Market Analysis Live subscribers have access to this, where I put my notes and a whole bunch of other stuff on there. I'm going to upload it for you. Bottom of the barrel here, bottom line is that at the end of the day, we don't know what's going to happen tomorrow, but interest rate hikes tend to actually have a positive impact on equity. All right. What does it also have a positive impact on? The U.S. currency. Why? I'm going to break it down to you like this. All right. If the dollar currently pays you 0.25%, if it now pays 0.5 to hold your currency in U.S. dollars, more people are going to want to buy the dollar to earn a higher interest rate in that economy. Therefore, interest rate increases are dollar positive. Therefore, the U.S. dollar is going to appreciate if there is a hike. Now, some people, and I'm going to show you what that US dollar chart looks like, DXY, some people would argue that since mid-October, that's already been reflected in the price. That hike has already been reflected. We topped out around this $100 reading on the US dollar index. Therefore, we might actually not see as much of upside. It might be muted because much of the upside's already happened. And speaking of a rate hike, TNX is the 10-year yield that we followed. This is basically the yield on a 10-year note. So if you bought a 10-year bond, you will earn 2.13% annually. Some people argue that since September, when they did not hike rates, we're actually from 2%, we went up to as high as 2.35. So there's that interest rate hike already happening in the 10-year yield. So it's not like all of a sudden they're going to press the button and this entire economy is going to collapse and things are going to explode into a billion little pieces. A lot of this sentiment's already been reflected slowly into this market. So don't panic. If they're going to hike, they're going to hike. The question is, what happens about the future? Will they hike like this? Will it be a slower hike? All right? Or will they keep it constant? I think through 2016, all right, end of 2015, they're going to hike rates and the chart's going to look like this. Up, we're going to stay still. They might try it one more time in 2016. So from 0.5, we're going to probably end up at 0.75 to 1% at the maximum by this time next year, at the maximum. That's not a big difference. On a couple $100,000 mortgage, that's probably $40 a month. That's not going to cause anyone to file bankruptcy. Okay, but the point is the sentiment, they're going to start hiking. They have to start hiking. Therefore, the market might overreact, but at the end of the day, it's not terrible for it. Okay, not yet. They start raising too soon or too quickly, it might become a problem. But for the most part, since 2015, the beginning of January, we had 1.7% yield on a 10-year bond or a 10-year note. We are now up to 2.13. So for those of the people panicking of a hike, this hike has already happened. It's already freaking happened. You've had 43-point hike in the last 12 months. So fear not, the economy won't collapse because of it. All right. That being said, what happened this week? What was the story that caused the market to drop so much? Huge drop in the equity markets. All right, 2045 was supposed to hold. This green zone here is a strong traditional support level. It did not hold for much more than 2 days, then absolutely shattered price on Friday. All right, I want you to know something. The price of Friday, that drop, was not Fed-based. It was not based on any kind of expectations of a hike. The entire story of Friday was oil. All right? Oil. Oil caused this equity market to tank. Now, remember a few months ago, cheap oil was something your analysts and the news would say, this is good for the economy. Cheap oil is great for the economy. And Market Analysis Live told you, it is not great for the economy. Cheap oil will eventually bring the economy to its knees because this is the stuff that powers our markets. All right, sure, it's cheap to transport goods. It becomes a little bit cheaper to transport the goods that you make. Sure, it's cheaper for airlines because they're going to save on fuel. Okay, that's a good play. Airline stocks have skyrocketed because of decreasing costs. Sure, it's great, but what happens when people get fired? What happens when Donald Trump's show becomes a reality? And say you're fired, and a whole bunch of people get fired. They can't afford to take a plane anywhere. They can't afford to put gas in their car. All right, they're just going to sit at home, not work, claim Medicaid, Medicare, whatever it might be, social benefits, welfare in Canada, and then the economy is going to tank. If people aren't paying into that and claiming benefits, the economy will tank. That's the long-term benefits or long-term repercussions of an oil drop. And I told you guys that since like freaking beginning of 2015 when this whole thing started to get all volatile. All right, cheap oil is good for nobody. Not this cheap. It's at $35.40. All right, will it bottom out here? This knife is falling. Look, this one big massive knife dropping from the 11th floor balcony coming to the ground floor. Don't catch this thing, guys. Stay away. But expect something like this. Let's go back to the last time that happened. I'm going to have to scroll back a lot. In fact, I have to go to 2009. Okay, let me zoom in where the drop in oil was a lot more dramatic, from 144 down to $36 a barrel in the span of July of 2008 to February of 2009, like 8 months. So it is not this dramatic at this time, but look how that bottomed out. I want to show you the behavior at the bottom. All right, this is 2009. Okay, somebody would have told you, oh, stocks or the price of oil can't be this low. 109, it's way too cheap. It was just 144, and they would have bought it here, and you would have foolishly bought it with them. Then it would have dropped. Then they would have said, oh look, the price rebounded. I should probably buy it. Guess what? Volume was low. You know what that means. Stay away from this crap. And then it dropped more and more and more. And then just when people said I had enough of oil, I'm getting out, it's going to just absolutely drop. It's going to go to the floor. And guess what happened? Look, it's going to probably bounce back a bit. It didn't. It just absolutely slammed itself to the ground. And this is what a bottom looks like. This is not a bottom. This is not a bottom. This is not what a bottom. This begins to be a bottom. An equal price with volume stepping in. That begins to get exciting. Now all you need is a new high in this scenario, above $50. Okay, anything above 50 gets exciting in this environment. And now you had that $50 break. Volume was still low, so you want to see a confirmation of volume being high. And then just like that, price gets higher, breaks the previous high with volume coming in. That, ladies and gentlemen, right there, boom, is a bottom. It is a beautiful bottom. You can take that and flip it on me. You could take that clip and make me sound like a real pervert if you wanted to, but it is a great bottoming pattern as prices start to put in new highs, new cyclical highs on increasing volume. And sure enough, if you bought that sucker and stayed in it, then you were the benefactor of a nice little rally right back up. All right, same thing is happening now. Let me just take you back to today because that was a long time ago. All right, some people called this the bottom. It was the bottom temporarily. We had a rally, okay? But at the end of the day, some people called this the bottom. They said $39, can't go any lower than that. Sure enough, it did. One thing I'm going to say, though, as oil prices drop, oil volumes are actually dropping as well, which means we could be getting into a neutral territory here. If this was really a strong sell-off, we'd see volumes like this, like just looking absolutely nuts. You could see the candles here. They are actually dropping off as a price drop. So this is probably capitulation. Capitulation means it is the point at which the sell-off is becoming a little bit overdone. And if I show you momentum, it's going to blow your mind what that looks like. That is oversold momentum. Okay, RSI down here, RSI, stochastics, and MACD all looking negative, but certainly not as negative as they've been. There's certainly more opportunity to stay down here and stay oversold for a long time. So we might not be done. If volumes come in, then the prices could tank. If the prices of oil continue to drop, the S&P 500 will take a kicking. An SH, the number one T, kicking. It will. It absolutely will, because that is the price of oil and its powerful impact on the market. Now let me show you something very fascinating about the equity market as a whole. Let's go on a weekly chart. Never forget this. All right, there's one thing I've taught you. It should be the T word, trends. Always believe in your trends. 09 was the beginning of a new trend that we are still in the middle of. All right, 2012, that fate was tested once, twice, 2013 once, and now in 2015 we tested it twice with that August low. We've rebounded from it, and we're still remain above this support line. Okay, that is how powerful that support line is. That is now a 6-year support line. So if you zoom in, actually before we zoom in, look, these dashed lines are Fibonacci. We've hit that, haven't we? We've hit it nicely, nice fib support, nice trend line support, and we've rebounded. So we're still, for the most part, in an uptrend, but we're really struggling to break above 2130. So we're testing that confinement. So as we move in here to 2016, right about, I would say, even here, all of 2016 can in fact remain in this zone. Look, 2016 could spend the entire year figuring out what happens to this triangle. And that's a bit of a precursor for our 2016 predictions webinar, because if we do that, we are still in a support zone, which means we are still bullish, all right? But we are failing at resistance. So as we move into 2015, the more we remain in this triangle here, the more fierce the move is going to be when we escape. If we break lower, we are officially going to enter into a global recession. And the technicals will support that. Now, if that happens, that recession will take us to the peak of the previous high in 2008. And I'm going to tell you this, it might shock you, but a drop all the way down to 1600 on the S&P 500 is still bullish. Why? Because we have primary cycle, secondary cycle retracement, and then from there, that is when the decision moment takes, which could literally be 2017 of July. Okay, we could be headed into that. So what I'm telling you here is this little frothy, nice up market that happened from 2009 until the beginning of 2015 is over. Say goodbye to that. This easy money here, it's over. This is when investors and traders are both making good money. We are now entering the market that investors absolutely hate, because they're holding on to stock that's going to get choppy on them. It's going to make them seasick, but traders will love because volatility is coming in. So 2015 and 2016, my TRADEPRO Academy business should do fantastic, because the markets are probably going to go sideways, be volatile, and they'll do crap. All right, let's go on the daily chart and show you something else. Double top that could have happened here. All right, but look at this. The S&P 500, all this tanking happened on very low volume, super low. The difference between this drop and this drop is the following. It is volume. Volume came in and it stepped in. This drop here that happened recently this past week, volume was super low, very low. Therefore, we can very realistically see a rebound up to about 2050 this week, maybe even right before the Fed will end up being in this mid-cycle zone. And that would make sense. All right, so don't panic yet. Don't get all wild here. We are at a very important support level. This 2020 should have held. We were liking for it to hold. The next low or next support is 2000. Here's a nice wick. Here's a close. Here's a few closes here and then through here. So 2000 is a key support. I expect any drops to 2000 to be met with a bullish candle. All right. And if that fails, the next support becomes critical. This is the green line from the 2009 trend, which should bounce. It should cause a sharp rebound like it has in the past. And that's where we are in the market. Right now, we're neutral with a slight bearish bias, but a support nearby, and upside has a resistance at 2130. So because we're in this sort of range-bound market with an ascending trend line, we're going to like iron condors, and we're going to like them a lot through 2016. All right, iron condors should make us 75% return on our capital this upcoming year. And I'm going to stand by that statement in 2016. I'm going to stand by it. And I'm going to show you that live if you guys are with me through these webinars. All right, so finally, how do we actually trade the stinking Fed thing? I'm going to give you a word of caution. If you are new as a trader, if you do not like risk, if you like more lower risk but higher probability trades, if you do not like volatility or dramatic volatility, then the way to trade the Fed Reserve is to probably disconnect your internet for this week. And just don't trade it. Throw away your phone, disconnect your internet, hibernate. You should cover yourself in tinfoil. Yeah, cover yourself in tinfoil because you won't receive any reception. You should go to your grocery store, buy like 80 packets in tinfoil and tinfoil your walls, and just be a hermit. That's how you play it. If you want to take a little bit of a riskier trade, which is borderline gambling, there are some trades you can take, but do not be surprised if they kick your ass, because they just might, and you have no control over that. Point I'm making is, if you like a little more risk, sure, take a few trades knowing that they're probably closer or a step closer to gambling than most trades are, so expect the same results. Expect unpredictability. If you want to know what volatility is saying, here is a good indication. The VIX measures volatility. Okay, guys, this VIX is skyrocketing. It is now at 24. I'm going to tell you something. The amateurs look to this and say, oh my goodness, this is getting expensive. The VIX is getting super expensive. Remember when we bought $20 to $27 December 11th VIX bull call spread? Well, we literally missed a couple $1,000 profit for 5 days. We just narrowly escaped it. Actually, even less than that, 3 days. But live and learn, that's trading. That's the kind of the live and die by options. You have to be right about time as well. But the bottom line is volatility is increasing because uncertainty is increasing, and more importantly, fear is increasing. As this VIX increases, so too is the fear. People are afraid of Janet Yellen haunting them in their dreams. And they're also, well, Janet Yellen and the Fed hike, obviously, not Janet Yellen alone, although she's a little scary sometimes. And two, they are also afraid of oil prices and a market crash. They're afraid of downside markets. So me looking at this as a trader who says, the S&P has sold off rather dramatically with low volume and falling into a very near support, everyone else out there is freaking out at the moment. I would say they're pretty close to panicking as well. And they just don't know what to do. They're uncertain, but they're more fearful than they are excited and opportunistic. And when everyone out there is fearful, I get excited. I got to tell you, I come from an aggressive neighborhood where I had to fend for myself, and you could smell fear. If you see somebody that's scared, you could tell that in their eyes, and you play into that. All right, you're going to get more aggressive if you sense fear. All right, the markets are not a nice place. You sense an opponent getting scared, backing into the corner. You got to snap at them and absolutely destroy them. I'm sorry to be graphic. It's a little bit aggressive. You people are going to be like, geez, George, you got to go to the gym and vent some anger. I'm not angry. I just put 42 holes in the wall to put up one shelf today, so it might be a little bit upset. But anyways, when people are fearful, I get excited. So markets are down, people are fearful, volatility is creeping up. Guess what I'm doing? What do you guys think I'm doing at 26 volatility? Well, I'm going to wait for tomorrow. I'm going to see, because it might creep up a little bit more. Monday and Tuesday and maybe Wednesday, we'll get some peak volatility. I wouldn't be surprised to see it at 30. All right, maybe even up to this high at 28, leading up to the Federal Reserve, because we're going to be uncertain until 2 p.m. on Wednesday. But as this volatility creeps up, and by Wednesday at 3 p.m., should we get into this zone, I'm going to sell options all freaking day. All day, baby. This is the opportunity here of the quarter. All right, I'm going to tell you something. With a $10,000 account, you could easily generate yourself a $5,000 profit selling options. However, just be careful, because you could just as easily lose the entire 10K if you don't know what you're doing. Don't get too excited here. These opportunities come up often enough that you shouldn't have to feel like you're getting into a trade because you're going to miss the train. Because you're going to be on another train. That's going to be the train to loss. All right, so I'm going to be selling options here. So the strategy for this upcoming week will be waiting until about Wednesday and going really wide on an iron condor. I'm talking about like 2160 at the least up top to like 1860. Wide enough iron condor that you have a huge range of move 45 days out. So I'm looking right now at January. What would be a good option here? January the 15th will give you about 1 month, 29th. January 29th of 2016. And how much money can you generate? I'll show you how much money you can generate. It's almost crazy. When people get really worried and scared, the opportunities that you could have in the market are absolutely insane with options. Especially when you price that fear. And you're like, these people are worried about an event. And they're over worried about it. So look at this, S&P 500. Let me give you an example. For those of you that do options trading, you're going to get this. For those of you that do not, we have a course that teaches you all about options trading. It's included in the membership price. You get like 24 webinars of how to trade, plus an additional 10 on options, 34 webinars. Each are about 60 minutes to 90 minutes. There's a lot of content for you, so don't worry, we have you covered. But let me give you an example here. Options for January the 29th of 2016 on the index, S&P 500. This is going to get ridiculous. Look at this. A 2010 call option. Okay? 2010. So 2010 current market value is about 2014. So it's really close. It's close, pretty much at the money. In fact, let's look at 2015 because it's closer to the money. It costs you $54, okay, to buy that option. To buy the put, which means if the market goes down, you're going to make money. To buy the insurance against a crash, it's costing you $61. That is $6 more, or 10% more, to purchase insurance to the downside than it is to purchase an option to the upside. What does that tell you? That tells you people are scared and they're worried about what's going to happen to the downside. And whenever there's a 10% premium to put options, I get freaking excited. I get super excited, and I don't care if everyone's scared. I want them to be scared so I can come in there and I crush them with my trade. And that's what's going to happen this week. So here's the trade. All that being said, with that preface, 1870, even 1860, if we sell that call option, that put, 1860 put, and we purchase the 1830 put, that alone generates us a $3 credit. Now let's look at a 2150 call. I don't even think we're going to get there. We could probably go 2140. Sell 2140, buy 2170. And that, ladies and gentlemen, generates us a high probability iron condor. And we are going to pull in 895 plus 545 divided by 2. $720 profit per each contract. Okay, we're going to multiply that by 5 contracts. $3,600 this week. Not in 1 week, obviously, but this is going to be the trade that I put in. All right, because volatility is high. Think about what we're saying here. We're saying that before January of the January 29th, I'm going to actually draw this out for you to put this in perspective. Here's January 29th right here. All right, I'm going to draw a triangle for you, or a rectangle. Come on, let me draw a rectangle for these people, for these nice people. 2140 is up here. All right, 1860 is down here, and January is right here. Okay, people, get ready to have your mind blown. We are basically saying that the market will either have to be all the way up here or below down here in this time period in order for us to lose this trade. When you look at this graphically, you're going to almost look at yourself in the mirror and say, holy crap, even this drop wouldn't take us there. Actually, this drop would take us there now. But it would literally take this kind of drop to make us lose this trade. And why is it so profitable? Why is this iron condor wide? These are called wings. Why are the wings of this iron condor spread out so wide? Because of fear. And whenever there's fear, options prices go up. And when options prices go up, your range can increase proportionally to the increase in fear. And you can say, all right, here's how it's going to break down, Mr. Trader. You're a fool and you think it's going to go up. Or you're a fool, you think it's going to go down. You want to predict the market? You go for it, pal. I will sell you those options. And I am right in this zone. And I am wrong in this zone. The other trader, as soon as they buy it, they have to be right. Price has to go in their direction for them to win. We have to have our price go against us to lose. That's the beauty of an iron condor. It's the best in these markets. High volatility markets, I'm all in. In situations where I do 5 contracts on iron condors, when volatility shoots up to around 30, I'll actually go 10. I'm going to increase that bet. I'm going to tell you one thing. Volatility does not stay overextended for an overextended period of time. Let me zoom in on this weekly to show you that. All right. When do you see volatility stick around 30 or above for a long period of time? You don't. It pops up, it drops, pops up, drops. It pops up, drops relatively quickly. Now, here comes the question. Do we think we're going to get a massive drop in markets? If we do, nothing says volatility can't go to 44. From 30 to 44, but that's only 14 points away. And if that happens, guess what we're going to do? We're going to write more options. I'm telling you guys, if you actually asked me like 2 years ago to do this strategy, I would have thought you're nuts. But I'm seeing the beauty in this kind of strategy. I've seen the beauty and I've seen the profits. I've seen 30% profit happen in a span of 2.5 months. Okay? I've done this strategy. I've back tested it. It's been profitable 18 out of 20 years. The 2 years that it was a losing strategy, it was only a losing strategy because markets were going up. So this strategy does the worst in upward markets. It does the best in downward markets or sideways, neutral markets. So this is what I'm saying. This is a great strategy. I cannot give you the strategy and how to put it in yourself, but every week we do new trades based on that strategy. Okay, so the strategy itself is patented. I will never sell it. I will start a hedge fund that executes a strategy before I sell it to anybody. I'm not selling out on this, but I will give you the trades as a result of the strategy. 18 out of 20 years profitable with an average return of 40 to 60% annually. So that's what I'm trading here. So this iron condor, that's an extension of that. I'm going to leave it on the chart for you, and we're going to do this trade tomorrow. Okay, it's virtually nuts to expect it to go out of those zones. Let's go in here. Let's put in a limit of negative $7. Let's hit enter. Let's go 8 contracts. And how much margin do you require for this trade? It's going to tell us in a second. If you want to do 8 iron condors, it's going to take you $45,000 margin. So you got to have a $45,000 account to do this. And the effect of that is going to be 8 contracts times, whoops, not 0, 8 contracts. What the heck? 8. Weird, 8 is not working on this calculator pad here. I'm going to return it. 8 contracts times $700. Looking at a $5,600 profit in the next month. All right, and it's a very highly probable scenario. For that type of profit, we need $45,000. Sorry, just change the pen width. We need a $45,000 account to generate that profit. If you want to choose a direction, I got a different way for you to generate profit. I'm going to put this trade in our account. I threw it in. We're good to go. There's $45,000 invested. A different trade you might want to make is as follows. You could, if you have high volatility, and you can't write options. You could also purchase puts on VIX. All right, and here's how this works. Because VIX is not a directional indicator, the fact that it's going up does not mean markets are going up. It just means volatility is going up. When it gets high, you can actually purchase puts, which speculate to the downside, or you can do it on VXY. John, what was, since you're in here tonight, what was that ETF they do? VXXY, I think? This is a good opportunity to do that on here. No, it wasn't VXNY, I think. UVXY. UVIXY. I'll never forget it now. UVIXY, Pro Shares Trust, and there it is. So you are actually riding the direction of that trend. All right? John, actually, at the time that you called, or you're saying you wanted to be long volatility, you were pretty right. Went up, it dropped, and look at it, now it carried through. So hopefully you made some bank on that, even if it was on a smaller degree. But there you have it, it's up. So if you want to do that, you can buy puts on this ETF. How much will it cost you? I'll show you right here. If you go under options trading, this is Interactive Brokers for those of you that are interested. You click on here, UVXY, because I wanna. PARTY, because I wanna. Same idea here is UVXY, because I wanna. And if you want to buy puts on this right now, you can do that. It's going to cost you, let me see, first of all, you got to choose the same expiration, same idea. If you want to purchase a put, it will cost you $1,120. All right, your delta is 35 points, so you probably want to buy a higher or a more in the money put. So let me see. Wow, these are very actively traded. So if you purchase a put here at 62 delta, how much will that cost you? $4,000. Okay, so it's a $4,000 cost, and for each 1% volatility drops, you make $62. Or wait 1 second. Yeah, $62. If it drops 15 points, let me just calculate this out. We're back to the UVIXY here. So it goes from 39 back down to average about 30. That's 9 times 60, $450. But it only costs you $1,100 for that. $450 into $1,100. That's one heck of a return. That's really good. All right. Now, even better, if you want to sell some puts, and if you only think it's going to go to 30 from 39, check this strategy out. This is where it's going to blow your mind. You could actually reduce your cost base by selling a put. So you go strategy builder, you're going to purchase the 65 in the money put option, and you're going to sell the maximum point of, what I think, 30, $450. Now you've actually reduced your cost to 4,000 minus 455. So now it's only 35. Sorry, hold on a second. I apologize. I said 1120 before. Since we're going deeper in the money, it's actually going to cost you 4,000. All right, minus the $500 that you sell, about $3,500 to generate a $450 profit. Not bad. All right, that's not bad. It's about 10% return literally in a couple weeks. So there's an opportunity there if you can't do an iron condor because it's really heavy on margin. If you just flat out think that it will drop, then don't even sell this $30 put. Just go straight 65 long, and you'll make a ton of money. All right, that's the UVIXY. You can also trade the VIX outright options. They tend to be a little bit more pricey. Actually, a lot more pricey. I'll show you a comparison. January, and they're also monthly, so there's no weekly VIXs, believe it or not. Not further out than current week. So they have the current month out to January, and then that's it. They're done. So 1.5 month to 2 month weekly options. So if you look at this, you can actually get delta of 70 for a lot cheaper. In fact, scrap this UVIXY ETF. Sorry, John. Go right on the VIX itself. Look at this. Let's build a strategy. If you purchase the $30 put, it's going to cost you $990. If you sell the 20, it's going to generate $2 for you. Therefore, net total $750. Okay, and if it does drop that much, 20 minus 30, that's 10 points times 100. It's $1,000. All right, so you can make $1,000 for a $750 investment. Not bad. And that's another way for you to do a bear spread. That's called a bear put spread using options. It's going to cost you money, but it could give you a return. It won't generate credit. So there's two ways to take advantage of this high volatility. If you're going to do it, try it out on your demo account if you've never traded it. Be very cautious because these are the kind of markets that are known to lay a beat down to traders, especially newer traders. Sorry about that, was my phone. But that's what I'm going to be trading. As soon as this volatility pops, leading up to Wednesday, even if markets go up, volatility will start to increase in anticipation of this FOMC event. And I'm going to do it. I'm getting in. I'm going to do some iron condors potentially on Monday first thing. As we lead up to Wednesday, if volatility is still juicy, I might layer into those trades and add more. So I'm going to be shorting credit. I can't wait to do it too. And tell you about it, brag about it on Sunday. Hopefully it works out well. Now, this past week wasn't friendly to us, guys. I'm not going to lie. I'm not going to sugarcoat it one bit. We had iron condors that were up about 3,000. Now they're down $5,000. I'm going to tell you why they're down $5,000. Because when we're doing a demo account, they get filled at the absolute worst price. So realistically, we're probably down $2,500. We're short volatility, and volatility increased. So here's what's happening here. This December or January 8th and 17th of December. So we have one December 17th that expires, one January 8th, and then one on January 14th. Let's look at the strike prices and whether or not we have to worry. Okay, December 17th expires this week. All right, so this trade right here is going to go dead this week. 2010 is our put side short, which is 2.55 points away. That's why it's sitting at a $2,000 loss, because we're just 10 points away from our short strike. All right, we did this trade somewhere in here, and we said 2010 is a nice low, 2150, it'll stay range bound. That's why we're getting our butt handed to us at the moment, because volatility increased a lot. When volatility is low, unfortunately, your range is going to be tighter to generate a good credit using options. So this 2010, it's going to be interesting to see what happens this week. We're going to have to do some kind of action with this trade. If it drops below 2010, in fact, let's set that trigger as 2,000. If it drops below 2,000, then we are going to just get out at a $1,000 realized loss, maybe even a little bit more, 1,800 or so. It's maybe even 2,000 at the height, depending on what volatility does. We'll take that loss. That's fine. Remember, it generated, how much credit did it generate? 545. So we've already been paid that cash. So our actual loss will be about around $1,500 or $1,450. You know what? Not a problem, because we've had so many of these things dry up that it won't affect us. You got to lose one or two trades occasionally. So this trade is in danger land. We have to manage it this week. What you could also do is buy back the put. So we're short 5 2010 puts. We can buy back these 520 puts, sell the 1980 protection that we own, and close out this trade, and basically just be left with this call option spread. That will effectively remove all of your risk for the week. I wouldn't do that yet. That's a panic move, especially since 2000 is such a strong support level. If this thing just closes above 2010 by the end of Friday, we're going to make $500 times 5, $2,500 profit. All right? If it just closes above 2010 by Friday. So that's worth it for me. $2,000 loss is worth a $2,500 return. So that one's right down the wire. January 8th, this iron condor. Over Christmas, markets tend to rally as well. There's a bias in there. So January 8th, we have a 2180 call, and 1970 put. So now we're down here. So we're okay. We're okay with that. That is below this level. I'm fine. We still have plenty of time for this thing to get down here. Now, a couple more crazy days like this, mind you, and we'll be right there. So maybe this week I might have to send out a midweek update to let you guys know. But this iron condor, I am not worried about one bit. January 14th, we have a 1950 put. So we're even further out on this one, 1950 to 1920. So I'm even less concerned about that. So an additional week for another 20 points or so. So at the moment, you don't have to panic. I know it doesn't look good. The market's down. I know, I get it. But it's at a nice support level. And I'm going to show you some technicals on the S&P 5 right now. Aside from I told you that 2,000 level, look at Bollinger Bands are starting to open up bearish. Okay, Stokes are already starting to come back and try to cross. When that's happened in the past, we got this rebound. Okay, RSI is also in a territory at which markets have historically turned from. Okay, we've got some rebounds. So we're at a fear point, and unfortunately, or fortunately rather, it's also the point at which you tend to get the shakeout to get everyone. Because everyone's short at the moment. Everything's going to go down. When everyone thinks it's going to do one thing, it does the opposite. That's how the market is. It's cruel. The only thing that worries me is this MACD, because it tells us the trend has changed. We're getting lower highs, lower lows, and we could over time get to this support level, but that would probably more likely happen like this, in which case all of our iron condors will be profiting in the profit, including this one that we're putting this week. Okay, we basically need dramatic action to lose money here, and that's the power of using options the way professionals do. Most investors use options to speculate in a direction. Most retail investors. Most professional investors sell those options for retail investors to bet. All right? That's just the reality of it. They maintain a neutral stance, trade less directionally, more neutral. Doesn't mean I don't like neutral, or that doesn't mean I don't like directional trades. I love directional trades, but the time is not right. You don't want to buy premium when it's expensive. It's expensive right now. Volatility, VIX is high. When VIX is high, it's not time to buy. Remember the saying, VIX is high, don't buy, options-wise. VIX is low, it's a go. Buy them because volatility can go up. When VIX is high, it's time to sell. Sell, 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 credit. That's what we're doing. That's just how the professionals look at it. If anyone else says anything else to you that's contradictory, they're amateur. They haven't done this long enough. Futures right now at the moment, because somebody asked me, they're looking a little bit more positive. They look like it's kind of holding the support at 2010. But I don't know. It's very early to tell. Nobody knows yet how the European session and the Asian session are going to play out. Okay, guys, any questions so far? Are we going to have individual equity trades? No, we are not. We're not going to have individual equity trades because they're all doing terrible. Buying stock this week is like asking to be shot. Well, okay, that's a little dramatic. It's suicidal to go and trade stock right now because we are at a much more macro junction in the market at the moment. All right, I would rather trade an index that's all encompassing than one individual stock, which you have no control over. Okay, it's not a diversified way to trade by buying one share. So right now, until this release happens this week, I'm not doing anything individual stock related. In fact, I should even cancel these. Look, Priceline, the bull call spread, I've actually closed that from last week. Oh yeah, we had our December 11th. How did I forget to brag about this? Our December 11th Iron Condor expired profitable. All right, so I think we made like $5,000 on that this week. We realized that $5,000 this week because we had 2140, 1950 put. These options never really got outside of the loss zone. Therefore, we ended up being profitable. We locked about 5,000. Actually, 7 times 5, $4,500. Not quite 5,000. Still pretty good. Good week. I I'm going to challenge you guys as traders to not look at unrealized profit and loss. Unrealized means nothing until it's realized. You have to close a trade before you actually lose money. If you're losing money on an open trade, it is not a loss. Okay? It's just a reading. And especially with iron condors. Don't get too flustered with open unrealized profits and losses. They mean nothing. Zero in the grand scheme of things. Okay? All right, good. Good. We have an iron condor portfolio open. We're adding a new trade tomorrow. We have this gold bull call spread, which is not doing too bad. I think we bought 102 to 107. We only purchased one of it. Let's see how it's doing. GLD. 102 to 107 up here. So we did a small entry position. You can see above 104.60 we had a trial entry for the bull call spread, which is basically meaning that we think gold's going to go up. If interest rates increase, gold will probably drop. Therefore, we should probably close this position. December 31st, we got 2 weeks. It's not really, it's not a good position to hold into Wednesday. So let's go trade, order ticket, sell the spread, one contract, and we're going to go at limit of, what's it trading at, $1.99. $1.99. That was also our average price, you'll notice. Therefore, we're trying to sell it at no loss. We might have to take a bit of a loss, like $20, to get rid of it. Which, whatever. It's a $200 trade. It's a bit of a joke. I just did it more so as a benchmark than anything. Okay, so if I could recap all of this, guys, for you, it ain't going to be an easy week. I guarantee you that much. I guarantee you this lady will be creeping and haunting you for the next couple days. I guarantee you, with that face as well. Just remember that face. And it's going to be tough out there. These are the type of weeks that force people to lose a lot of money. So if you're somebody who can't control their emotions or are new in this profession, in this new career, stay out. Stay out of this. You can't lose money if you're not invested. Nobody has ever lost money that has sat in cash. Wow, that's not true. Inflation's done that. But what I'm saying is if you don't take a trade, you can't lose it. And sitting on the market on the sideline and watching the chart while something happens is the best way to learn without any emotional attachment. Okay, so for those of you that want to do that, sit aside. For those of you that don't, iron condors, that's my play. For those of you that don't have that kind of capital, bear put spread on the VIX is a good idea. Again, make sure you wait until Wednesday if you're going to even explore that possibility. Question this week will be, will oil continue to sink or will we get a rebound? If a rebound happens in oil, we'll get a rebound in S&P 500 along with markets. The other massive question is Wednesday, what will the Fed do? Just to summarize the three outcomes for you, let me do it on the chart. The Federal Reserve hikes rates. Let's say Wednesday we find our way up here, we claw up a little bit higher. You might see some daily volatility. The candle will probably look something like this at the end of the day. A lot of volatility, but it's not going to really go anywhere. It'll close flat if they hike the rate by 25 basis points and they say we're going to be patient, and in 2016 we're going to do very few raises and be very, very cognizant of what the economy is doing. We're going to go slow with this. That's what's going to happen. If they say 50 basis point hike, which is very unlikely, the market will probably drop. And if they say we're going to be more aggressive, we're going to raise rates quickly, the market will drop. All right? They're not going to do that. The most likely scenario, 80% likelihood, is that they do not increase by more than 0.25%. They also stay patient with their outlook. Then that's already priced in. Then we're going to stay out in this area right here. We're probably going to camp out above 2020, I would predict, if that's the scenario. Now, the other more volatile outcome is if they say no hike. We are not going to raise rates. That will be a scary one because nobody knows. Nobody or their brothers, mothers, cousins, uncles, cat or dog do not know what's going to happen, if that's even possible. brothers, mothers, uncles. I guess it could work. They don't know what's going to happen. If there's no hike, two things can happen. The market could say, yay, let's go higher. Free money for longer. Woohoo. More loans. Or they can say, wait a minute. That means the economy is not bad. If the economy is not good, it's actually bad. This recovery probably isn't that strong in the eyes of the Fed, and it's going to drop. So obviously, these are the two things that can happen. Market could go up and market could go down. And that's the amateur's guess, but there's also a third option always. Market could go flat. And that's actually the more likely. 60% of the time, markets stay flat like this. They don't move. Only 30% of the time, the 35 and 60 to 65%, they stay flat. 30 to 35, they move. They're directional like this. So odds are we're going to stay flat. All depends on Fed. All eyes on Janet, which is an interesting statement to make. I'm sorry, I just hydrated. I've been blabbing a long time. Hopefully with value. But yeah, that's my spiel for this week. Keep your eyes pasted to the screen. 2 p.m. Wednesday, the 16th. That's the big date. That's the big time. Until then, we're probably going to camp out here in a really tight range. I don't see there being much movement unless, of course, oil does something drastic. Then the market will follow. Okay, for those of you that want to follow and may not be in the U.S. time zone, you have the likelihood of doing that on ES1. So if you go ES1 exclamation mark, if you go to tradingview.com, type this symbol in, that is the futures price of the S&P 500. And right now it's slightly positive. So it's finding some support at this 2,000 level. All right, guys, any questions, comments, concerns? Is anyone excited? Or not? Is anyone not excited? And if so, then why not? Why aren't you excited, darn it? By the way, look at this. If you go to cmegroup.com/trading/interest rates/countdown to FOMC, or easier, if you go to Google, Fed Watch Futures, December 16th, expectation of 80% to be at 50 basis points. January 27th, expectation of 50 basis points. March of 2016, that's where they're pricing in a potential other hike. All right, this is what at the moment the market expects. So if the Fed says by March of 2016, we're going to see a 1% interest rate, then that's going to be a higher expectation here than the market's pricing in. Therefore, markets might drop. So what she says is going to be compared directly to what the market is pricing in. That's what you're trading. Careful out there. Some people think it's all linear. If it goes up, then the market's going to go down or blah, blah. There's much more depth. It's not just what she says. It's also what she implies in the future, how she says it in comparison to what's priced in. And you can see by the end of 2016, November 2016, it gets a lot more, the distribution gets a lot more wild, and there is about a 32 to 28%. So combined, 60% chance we're going to be 0.75 to 1% this year. What did I tell you before? The same thing, because I didn't make it up. I look at this stuff. I'm not smart enough to know where interest rates are going to go, guys. Not an economist. I don't care to be an economist. I'm a trader. It's different. All right, and there's some wacko out here that thinks it's going to be at 2%. Good luck. Good luck, buddy. You are what we call tail risk in statistics. That's not going to happen. Majority of people expect it to be 0.75 to 1%. So good luck. This week's going to be interesting. I will send you all. That's an interesting comment. It may go one direction initially and then reverse. Why didn't we look at that? Last time that rates were actually hiked, or not hiked, sorry, that last interest rate decision day was right here. And this day was September the 17th, I believe. Yeah, that's correct. September 17th. And I'm going to show you. I'm actually going to zoom into that day. Hopefully it lets me do 15 minutes. If it doesn't, nope. I'm going to go on my IB account because I pay for data here. And I will change this to be ES December. This is the futures. I'm going to drop in 15-minute candle. I'm going to go back all the way back to September. Do you imagine you could do that with your life, go back in time? What would you guys change? A lot of things. Yeah, I bet. Let me zoom in a little bit more. Okay, so here's the Fed hike expectation. There was about 60% to 65% chance probability back then that they would raise interest rates. Here's what happened. This was like around incorrect. That was not at 8 p.m. Anywho, this was the hike right here. I remember it specifically because I traded it. Oh my God, this is why. What am I doing? It was 8 p.m. because that was in Europe. I apologize, guys. That was DAX. DAX is the German market, the German futures. Let me go back. Give me 1 second. You have to see this. I know you might want to leave, but you can't because this is so important to you, especially if you don't have access to futures or the S&P 500, because you got to know what could happen in these circumstances. I'm going to go back to September 17th. If you guys remember that day, most people were expecting an interest rate hike. It did not happen. Back then, there were a lot of uncertainties about China and what that economy would look like. It looks irregular, by the way, this price, because this is a March contract. Technically, we should be looking at December futures contract. Oh, I have one more thing to show you volatility-wise. Anywho, I'm going to park that for 1 second. Okay, it's just, if this was a December contract, you'd see a lot more price in here. But look, leading up to the Fed decision, 12:45, there it was. 1 o'clock, there was some. This is actually 2. I'm 1 hour behind on IB. So as soon as 2 p.m. hit, market initially skyrocketed. I remember that. It's made about $600 on this trade on ES because I had long futures. Look at the newsletter I just sent out. You'll find the exact same setup I traded. I'm going to do it again on Wednesday with futures. So I went long. I saw it kind of drop. Then I got out. And then it just went right back down. Think about that. Skyrocketed, dropped back down. All this is, the next 15 minutes, another up and down candle. 15 minutes after that, it resumed the direction. 15 minutes after that, it was at a high. 15 minutes later, it was pretty much right back to where it started. And that was at 2 p.m. or at 3 p.m. because it's always 1 hour. Then it dropped a lot. Then it got bought back in. Then it did another like indecision candle, trickled lower and closed the day lower than when it started after the seesaw action. So in 2 hours, this is what you had to endure. That's why I said if you don't like risk, if your stomach turns at the idea of risk, this is what you can expect on Wednesday. So yeah, oftentimes you'll have a break in one direction with these interest rate FOMC days, followed by a sharp reversal and then continuation. So if you do want to trade it actively with the futures, wait for the pop in either direction, wait for the retracement, and the first idea you see that it turns, get in. That's a 60% likelihood you're going to win that trade. That's how I'm going to be trading it throughout the day. Most of you guys have jobs, so I'm not going to day trade these setups because you probably don't want to be doing them yourself. All right, so you expect this. That's what's going to happen this Wednesday. The other thing I wanted to show you lastly to end the webinar and open up for questions for you guys afterward is futures are always an important reading because they are the future expected price determined by the market. So that's why a futures contract is important, because it is the future dated price trading at the moment. This is what people think will happen in the future. So take your crystal globe. 1 second. So when you're looking at volatility, make sure, when you're looking at volatility, look at VIX, and the VIX has futures that trade. You might have to pay data for them. On Interactive Brokers, delayed data is free, and it's enough. All right, so if you have IB, this is enough. You don't need any more. But look at this. December of this year, it's 23. That's the future price for VIX. January, it's 21.35. February, is 21.05. So the expectations of futures is actually negative, which is called backwardation in the futures market. It could be in backwardation or contango. Contango means prices are higher as you go out in time. All right. This is not a contango market. It's backwardation. So therefore, the current expectation is short-term volatility with long-term drop-off in volatility. Guess who that benefits? Iron condors. Duh. So why do you think we're doing it? Because volatility is high? Because I don't think the market's going to go directional for a long period of time over the next 30 to 45 days, as well as the structure of futures for volatility is actually in backwardation market. So they support our theory. So it's not just me expecting this stuff. It's not some crazy guy talking to you at a webinar that you should trust. It's the whole futures market that you should trust. There's a whole bunch of market makers, professional institutions that hedge their positions. And it's a soup of trillions of dollars. Actually, I'm not going to say trillions, but easily billions, hundreds of billions, so close to trillions that gets exchanged in these markets, especially on the VIX, massive contract. If you're a hedge fund manager that expects volatility, you're buying these futures. If you are a pension fund that is responsible for generating monthly cash flows to retirees, you're buying these futures to protect yourself from volatility. So these futures are pricing in a drop on a month-to-month basis of volatility. So if we are here and we sell credit, this drop will benefit us greatly. Okay, that's my rant on volatility. I wanted to do a VIX SPX session with you, talk about oil, talk about the US dollar, talk about the global markets, talk extensively about Janet Yellen and what a great fan I am of her. I'm her toughest critic. I bet you if she ever saw me in person and I chirped her, she would probably put me in my place, but she doesn't come to these webinars yet, so I'm safe. She will be here one day, I guarantee you. Any questions from you guys? Make sure a comment. Make sure you have the day off if you want to trade it. Strongly agree. Strongly agree. Have the day off. If you do not have the day off, then you're going to be expecting to see this kind of volatility while you work. And don't be Joe Campbell. Remember that guy? The short of the stock went to a meeting and came back owing $150,000 on top of the 30 he lost. Don't be that guy. If you can't be in front of the computer, don't trade that time frame. Here's what I mean. If you're trading a 5-minute candle chart, make sure you could look at it at least twice every candle period frequency, twice per 5 minutes for the entire duration of the event from 2 to 4 p.m. Okay? Now that's it. That's all I got. That's all you guys have. On behalf of myself, Janet Yellen, and the entire Federal Open Market Committee, we wish you an eventful trading Wednesday, December 16th. We think we're going to see a rate hike. We think it'll be tame guidance for the future. And we don't think the markets are going to panic. We think we're going to see some stability. Volatility is going to drop off. And we're just going to kind of say, hey, let's live this through. Let's enjoy our holidays. Statistically, holiday trades, especially through Christmas, the Christmas season is a positive month. So remember that. That also comes into play. All right, guys. Oh, one last thing. You also have tax loss selling and all other good stuff we're going to talk about next week. And we're going to digest what just happened as well. I might do a special webinar on Wednesday night if conditions get hectic and it's called for, but I'll send out an email. You guys have yourselves a wonderful evening. Enjoy your Monday, Tuesday, and do not have a heart attack Wednesday afternoon. Please, oh please come back to me next Sunday. Take care, guys. Have a good evening. If you have any questions, you know where to find me. Take care, and goodbye.